There has been record immigration into the United States from the southern border since 2020. This is likely to lead to a population explosion. Not only that, there has been an increase in intrastate migration within the United States into the Sunbelt areas where the property prices are lower and also job creation is better. So these areas are seeing significant population growth and increase in property prices. There is also a trend towards renting in the younger generation, as they could not afford to buy property due to increasing house prices and increasing interest rates. All these trends will benefit our next investment analysis, the Camden Property Trust. They operate in the Sunbelt areas and focus on multifamily apartment properties. They will also benefit from falling 10-year yields, as the interest that they have to pay on their debt will also fall. Camden Property Trust, an S&P 500 company, is a real estate investment trust, REIT, primarily engaged in the ownership, management, development, redevelopment, acquisition, and construction of multifamily apartment communities. They are headquartered in Houston, Texas. Camden owns and operates 172 properties containing 58,634 apartment homes in 15 major markets across the United States. Over the past 5 years, the stock has ranged from around $60 to $180. The performance of the stock has tracked the S&P 500 until 2022 when the interest rates were raised. For the last 2 years, it has underperformed the broader index by a significant percentage. However, more recently, it is starting to show strength compared to the broader index. This is most likely due to the expectations for falling interest rates. They are currently trading around $113 and pay a dividend yield of 3.65% and market cap of $12 billion. Within the apartment REIT sector, Camden Property Trust is the strongest after Essex Property Trust, as you can see from the relative performance chart. But we like the areas that Camden Property Trust operates compared to Essex Property Trust, which operates predominantly in California and Washington. 2023 highlights. Core funds from operation, $6.82, an increase of 4.6% over 2022. Same property revenue, increase of 5.1%. Net operating income, increase of 4.3%. Sold off 2 older apartment communities in California and 1 in Atlanta. Dividend growth. They have grown their dividends slowly and consistently over the past 5 years from $3.20 to $4. The FFO and core FFO has also grown from $5.04 to $6.82. Financial strength and stability. Camden has one of the strongest balance sheets and highest credit ratings in the REIT industry, with financial flexibility and access to a wide variety of capital resources. They maintain a low leverage and ended 2023 with net debt to EBITDA at 4.0 times and a total fixed charge coverage at 5.9 times. As of February 29, 2024, they had approximately $1.3 billion of liquidity with full availability of unsecured credit facility. They have a minus stable credit rating from Fitch and A3 stable from Moody's. The weighted average on their debt is 4.2%. Weighted average maturity of the debt is 6.5 years. Camden's strategy. Focus on high growth markets, employment, population, migration. Deliver constant earnings and dividend growth. Operate a diverse portfolio of assets and maintain high-quality resident profile. Recycle capital and create value through acquisitions, disposal and redevelopment. Maintain a strong balance sheet and low leverage and ample liquidity. They operate in the Sunbelt area including California, Arizona, Colorado, Texas, Florida, and North and South Carolina. These are the regions which have benefited from intrastate migration within the USA. Camden resident profile. Average annual household income, $120,000. Average rent to income ratio, 19%. Average number of occupants, 1.7. Capital recycling. Since 2011 we have significantly improved the quality of our portfolio with minimal cash flow dilution, using disposition proceeds to fund development and acquisitions. They disposed of $3.8 billion of older properties and acquired $2.7 billion worth of newer properties. Multifamily supply. One of the important considerations on the profitability of apartment REITs is the supply of the apartments. There has been a building spree on apartment properties, but things are starting to tail off. Starts began to fall in 2023 and are expected to fall by 50% in 2025. Completions are expected to peak in mid-2024 and decline significantly in 2025. There is a strong demand for multifamily rental housing with a favorable demographic trend, with nearly 70% of the adults between the age of 20 to 34 choosing to rent. Many people still choose to rent rather than buy, with higher propensity to rent in CPT markets versus US average. Homeownership rate overall remains near long-term average of 66% and is significantly lower for young adults ages 25-34 at 42% and ages less than 25 at 23%. Move-out rates for home purchases remain low at 9.6% in 2024 to date versus Camden's portfolio peak of 23%, and long-term average is 14% young adults choosing to marry and have children later in life, delaying homeownership decisions. More households across the nation are choosing to living alone, which increases the share opting for apartments. Percent of young adult households with married adults and/or children has declined. All of these are favorable for Camden Property Trust, and we rate this as a buy. Again, these are just our own views and not investment advice. We are not financial advisors. But we have this on our watch list and plan to buy on any weakness. We hope you liked this video. Please like and subscribe for more research like these.